I didn't want to quit my job when my passive income was almost equivalent to what I was earning. I said, okay, let's do a 2x or 3x of my pay. Then we can be a bit more safe in terms of anything might happen on the business side of real estate.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Mike Murphy at JB Harrison Insurance, helping real estate investors to understand and choose their best options for all their insurance needs. Call 616-868-0050 or email mikem@jbhins.com. Hello and welcome to episode 153. My guest today is James Kandasamy, the owner of Achieve Investment Group. James has built a very impressive portfolio of value-add multifamily and apartments in San Antonio, Texas. He currently controls over 1,000 units worth $65 million. James, welcome to the show.
Hey, thank you, Brian, for having me.
Why don't you just tell us a little bit about yourself and how you got started investing in real estate?
Well, I'm James Kandasamy from Achieve Investment Group. We are a company based out of Austin, Texas. We focus a lot right now on the San Antonio market, even though we are expanding to other markets as well, like Austin and Houston as well. We right now own and control assets around $65 million across 1,000 units, which is across 6 large multifamily properties. And that's what we have right now. And we are a vertically integrated company, which means we do asset management. We have direct relationship with our investors to raise money. And we also own the property management, and we also own our own construction company. And that's how, we are able to buy value-add deals and turn it around quickly. And we started from single-family real estate rentals. We started with 13 properties. 2 of it were flip, and we promised not to do flips anymore. But we had like 11 rental properties. We started somewhere in 2013, and within 2 years, we built up that 13 houses. And after that, we moved on to multifamily for scalability.
Yeah, and when you talk about scalability, going from 13 single-family, fix and flips to over 1,000 units in what, like less than 5 years? I mean, that's an incredible scale right there. So,
absolutely.
Yeah, I know you have some thoughts on the difference between investing in single-family versus multifamily. Why don't you share some of those with us?
Yeah, absolutely. So single family is awesome in terms of quickly getting started. You can buy deals in single family quickly compared to multifamily, right? Multifamily is much more bigger, larger scale. But you can find single family deals out in the market even now. I mean, this is peak of the market right now, 2018. You can still find great deals in single family if you find the right way. And also your cash and cash is much higher than multifamily. And so we started with single family because our capital, we only had like $50K when we started with single family. And we bought all our single family at like $6K cash out of pocket on average.
So $6,000 a door is what you were paying for the single family.
Yes, correct. Yeah, we bought it using our BRRRR strategy, using OffMarket sourcing, and we rehab it and we turned it around and we refied our single family multiple times. In fact, I think all my single family were at least refied twice to pull out the equity. So after 11 single family, we basically built up of equity of $400,000 within that 2 years. And our cash and cash was more like 30 to 50%, and a lot of it were infinite because there were like 6 different single family, which was like almost zero cash out of pocket. So single family is good to get started. You get high cash and cash, but the amount of work that you have to do on single family, it's a lot because we were managing it directly. We had insurance expiring at different time, and we have to do so much paperwork because we are doing all the paperwork. I think taxes were fine because we only paid end of the year, and we were dealing direct with the tenant. So it's a lot of work for direct owners in terms of single family compared to multifamily, where you have staffs in place, you're able to scale, and we know our skills in terms of managing large projects. So we are able to do much better in multifamily, and the scalability is just so huge in multifamily compared to single family.
Yeah, so that's the big question here is how building a portfolio of 13 single family. That's impressive right there, and I think that's a great accomplishment in and of itself. But building a portfolio of 1,000 multifamily units, that's kind of mind blowing. How were you able to just shift gears from the single family into the multifamily and scale so quickly?
Well, at very high level, it's hard work and mindset, right? So, and keep in mind, this 1,000 units were, okay, so we started in 2013, this is 2015. So we did single family for 2 years, and the multifamily is 3 years. So 1,000 units in 3 years, which is like, 300 units per year, right? But if you look at what we have bought in the past 6 months, we bought almost 600 units. So we started slowly, like up to 300 units, and I was having a full-time job at that point of time, and when we were buying another 400 units, I decided to resign from my job and focus on this full-time, right? So of course, hard work and mindset, and the other factor is my wife is also helping me. So basically, we have split our job since we started, where I focus on finding deals, acquiring them and financing them and working with investors, whereas she focused on the post-closing aspect, which is basically rehab, construction, and property management of the property. So, and she's very good at that, and I'm very good at acquiring deals at great prices. So it's basically a good tag team that we have, right? But anybody can do this, right? If you have the right mindset and if you work hard on it.
Yeah, a couple of things in there. One is you're able to partner with your spouse, which is fantastic, and you both complement each other.
Yep.
You're good in one area, she's good in another area, and that's fantastic. And the other thing is you started building this portfolio while having a full-time job.
Absolutely.
Which you just left this past year, didn't you?
Yeah, I left like maybe 6 months ago. So I didn't want to give up my job. I know some people think that you already make equal to your income minus expenses. If you have enough income to cover your expenses, you are retired, right? So for me, it was not like that, right? So we have a family and we have 3 kids, who are. My first one is going to college this year, so we just can't simply resign and try to do this full time, right? So what I did was, when I was looking at deals while I was working, of course, as I say, work hard. Work hard means you have to extend your whole day, right? So I woke up like very early in the morning, do my morning rituals and start working while everybody was sleeping. And it's all about morning rituals, and we work late night, and it's basically hard work by extending your day.
Could you just give us a glimpse into the conversation between you and your wife when it came time to quit your job?
Well, it's very tricky, right? Because so the conversation was, okay, so I didn't want to quit my job when my income was almost equivalent to, when my passive income was almost equivalent to what I was earning. I said, okay, let's do a 2x or 3x of my pay, then we can be a bit more safe in terms of anything might happen, even on the business side of real estate, right? So we said, if we hit this much target, 2x or 3x of my pay, then we can focus fully on real estate. So that's where the decision point came in. We were like almost at like 700 units as a sponsor to have like 2x or 3x of my pay. Then we decided, okay, now it's safe bet for me to quit. And I'm electrical engineer with an MBA, and I was really paid very well. In fact, even just with my pay, I can be an accredited investor. So I was paid very well. So, if you want to earn that much, you need to make sure that you are able to get, you have a solid footing on the real estate side to to quit your job.
Yeah, absolutely. But so you didn't just equal your pay from your W-2 job. You got it to 2 to 3 times. Your income from the real estate was 2 to 3 times what you were making at your job before you felt comfortable quitting.
Correct. Yeah, I don't know. We are a bit conservative. I know sometimes, real estate can sound sexy and people are making tons of money, wealth is created everywhere. But, it's, everybody's a champ in the bull market right now, right? So we are very, very cautious about, simply resigning and just doing this full time. So we want to make sure that we have that buffer in terms of our passive income or income coming in from real estate before we resign from the job.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. And it sounds like you were also not just investing in real estate, but building a business and managing that real estate as well while you were still working full time.
Yeah. Real estate, if you're an active investor and especially if you're doing commercial real estate like multifamily, the overall thing is a business, right? So you need to have your own marketing, which means you have to be able to access investors. You need to be able to have teams in place, lenders, construction crews. You need to have processes and systems. So it's a big business. Sometimes you don't realize how big is the business. When everything is going fine, you can give it to third parties, but it's a business by itself. There's a lot of moving parts in multifamily.
Yeah. Now, are you is the team that you've built? Are you only managing your properties, or do you take on other properties?
No, right now we are only doing it for ourselves. We are still putting in processes and systems. We hired a consultant to put in systems and processes, and we have started to build our own corporate stuff as well. We hired an acquisition analyst, asset manager, and we have a regional manager right now to take care of the operation. So, but all of them are doing it for ourselves as well. But once we are done with our process and system within our team, for my own company, we do plan to extend it to third-party management and all that.
Okay, so you're hiring the right people to fill the positions to keep that system running smoothly.
Absolutely. Yeah, it's all a learning process, right? So, but we do believe that we have to own the entire pipeline of acquiring in until the property management side of it, just because. We do a lot of value add deals where it needs a lot of attention in the beginning. And even after stabilized, right? Even after stabilized, things become much easier. So it's might as well be just go and manage it. But the beginning part for value add deals where we are putting in a lot of capital into it, we are pushing up the rents and we are reducing expenses and we are doing a lot of capital improvements. So there's a lot of coordination and effort that's needed from us. So we believe in, vertically integrating our whole key processes and teams.
Fantastic. And before we go on, you mentioned your morning routine. I'm curious what that involves.
Yeah, it involves waking up early morning. I read this book called The Miracle Morning by Hal Elrod, and it was revealing. Even before that, I used to do morning routine where I do meditation and trying to focus on myself. But basically the Miracle Morning routine says you have to do like five things, which is they summarize as savers, which is basically you do meditation, which is the silence, affirmation, you affirm yourself, and actually I'm not sure what's the others, but let me see. I think you do journaling, where you journal about what are their goals, and you listen to good positive vibration stories or inspirational stories, you can go to YouTube and see it. And I think the last one is basically where you do your exercise in the morning. So to make sure that your mind is focused and you're able to get a lot of things done in the beginning. So end of the day, what my ritual does is basically you are investing in yourself, right? It's all about mindset setting, it's tuning your own mind, making sure you have the right focus without any distraction.
That sounds really interesting. You're the second person who's talked about that Miracle Morning book on the show. I also interviewed Paul Chi, who you and I both know, and he said he's very high on that book as well.
Yeah, it's a very good book. But I mean, the book is a book, right? So someone have to execute it, right? So it comes back to the mindset and how much do you really want something in your life. If you really want something in life, you will go and find the resources, and you will wake up early morning, and you will do all the things that will contribute to your personal development, right? So that's what Jim Rohn said. Your growth can't go beyond your time and investment that you put into your own personal development, right? So the amount of time and investment that you put into your personal development, which is basically your inner development, will be your limiting factor to your personal accomplishment.
Let's talk about some of the numbers and the properties that you've done. I know you've had some successes, and I'm wondering if you'd be willing to share the numbers on one of your properties.
Sure. So I can share two numbers where we have gone through almost a full cycle. When I said almost a full cycle, I mean, we have these properties for 3 years, right? So the last 3 that we bought is so new, so there's no point of really talking about it. But the first 2 that we did, the first one we bought was 45 units. We bought it at 1.5, and this is going to be sounding crazy. We bought it at 1.5. In 12 months, we refi and pulled out 117% of our money because it was appraised at 2.8.
Wow.
So we basically, so that's the power of multifamily, right? The fast appreciation. You can never do this in single family, right?
When it comes to rental property insurance, understanding the costs, choices, and benefits can be overwhelming, and finding the right insurance provider can be frustrating. I had one company cancel 5 of my policies all at once for no good reason, and that's why I'm happy to have Mike Murphy from JB Harrison Insurance on my team. Mike is an independent agent who has always been able to find the right policy and the best provider for my insurance needs. Over the past 5 years, Mike has not only become my go-to insurance agent, he's also helped me manage risk, add value, and save money. If you are looking for insurance on a new acquisition, or you believe it's time to get a more comprehensive look at your entire portfolio, then Mike Murphy is the independent agent to call for all your insurance needs, auto, home, and business at 616-868-0050 or email mikem@jbhins.com.
What were some of the things you did to add that kind of value?
Well, first of all, we bought that deal at a really good price just because we did our off-market strategy of yellow letter marketing and text blasting. So we found a deal from direct seller. When he sold, it was sold at market cap rate, but there was a lot of upside in the deal. The property was mismanaged and all that. So we bought the deal at 1.5. We put in almost like $500K into it to rehab the property interiors, and we push up the rent. That's what fundamentally we did. Basically, upgrading the interiors and pushing up the rent, and did some exterior work, even though not major, but we're able to create so much of value. Within 12 months, we're able to refinance, and we still keep that property. It's on an infinite return right now because we already pull all our money out, right? So. And it's still giving almost a high on the high tens. I mean, high tens percentage in terms of cash and cash for passive investment.
Nice.
For a passive investor. And,
so what you're saying is your investors, you were able to pull out all their money and they got their money back, right?
Oh yeah, within 12 months.
So they're really making an infinite return because they no longer have money in the deal.
Absolutely. That's the power of fast appreciation in multifamily.
Wow.
Right.
Nice.
So, yeah, I mean, key thing which I should have mentioned at the beginning, but I want to mention it right now for the single family versus multifamily, right? So multifamily, your value of your multifamily, it's based on the comps surrounding the multifamily. So you can go and build a multifamily in a neighborhood of 100,000 average house. You can build a palace in the middle of that that $100,000 house. When you want to sell that house, you may have spent $1 million, but you're going to get probably 120 or 130. That's it. People are not going to pay more than that, right? Because it's based on all the comps surrounding it, right? But in multifamily, it's a business by itself. It's an investment stream of income where investors buy it for the purpose of getting returns on their investment. So the power of multifamily is you're able to buy a mismanaged or a deal with an upside, and then you're able to realize that deal by forcing the equity, by increasing the income and reducing expenses. By putting in capex into the deal, you're able to increase the basically the net operating income, and you're able to increase the value as an investment basis. And the banks and the buyers of multifamily realize that, and they're able to pay you higher just because you have the NOI is much higher.
Yeah, it's a powerful mathematical formula when you take the net operating income and what is it? You divide it by the cap rate, and it gives you the value of the property. Well, every dollar you save in expenses and every dollar you can add to your income, that's increasing the value of the property at an exponential rate.
Absolutely. If you look at the if you can Google, the IRV triangle or IRV triangle, it basically talks about how the commercial real estate works in terms of valuation, right? So if you look at that valuation, every 10% increase on the NOI, which is basically the I on the top, will increase your value by 25%. And usually you put in 25% down on a multifamily. And so basically when you increase by 25%, you're able to take out 25%, which basically means you have infinite return because there's no more cash in the deal anymore, right? Of course, there's some closing costs and all that there, but that's at high level how you're able to force appreciate and get infinite return. And keep in mind, every time you take out money, you can go and invest that money in somewhere else, right? So every 12 months, if you do, take out the same amount of money and put it in another deal, your internal rate of return will be like multiply, hugely, so you'll make tons of money because you're multiplying your money every 12 months. It's compounding effect. And if you look at Warren Buffett, his internal rate of return is 20%, and that's how he become so rich in the past 20 to 30 years he's in the business, because he's getting like 20% IRR. And to relate that to my first deal, which was the 45 units which we bought for 1.5 million, our IRR on that deal for a 5-year investment cycle is 40%.
I'm sorry, say that again. 44%?
It's above 40%.
Above 40%. That's fantastic.
Yes, correct.
That is incredible.
So yeah, it's if you find the right deal and if you're able to execute your business plan effectively, you can definitely make huge amount of money by keep on reinvesting your initial down payment.
Yeah, and that 40% internal rate of return, that's per year. That's not like all together.
No, that's 40% is for 5-year investment period, right? So if you look at per year, it'll be much higher, right? So let's say that if you have refinanced 170%, let's say we have even sold that property in 12 months, right? So we double the equity, right? So our IRR would be above 50 to 60% if you have sold that property within 1 year.
Wow, very nice. Very nice. That's right, incredible. You mentioned, I want to go back to something you mentioned. You mentioned was it the IRV triangle?
Yeah, it's called the IRV triangle.
And what does the IRV stand for?
So I stands for the income, which is basically the net operating income of any commercial properties, right? R is the cap rates. R is for the rate or cap rate. and V is the value of that property, right? So if you have I on the top and then V and R is on the bottom, right? So to get I, you basically takes V times R, whereas to get V, it's just it's a division and times. It's a pretty simple formula.
Yeah, I think the key point here is it's mathematical. The beauty
It's
of commercial property is there are mathematical formulas that can tell you pretty close to the ballpark of what your property is worth at any given time.
Absolutely. Yeah. At a 5% cap rate, every dollar that you increase on NOI on income is basically times 20, right? So that's how it works in the commercial real estate.
Yeah, and the better you can understand this concept, the better a chance you're going to have at making real profits in multifamily.
Yes,
I think it's something that a lot of people overlook, the mathematical concepts behind investing in multifamily and apartments.
Absolutely. I mean, when I was doing single family, I have a lot of friends who was doing multifamily, and I was rocking it here at 30 to 50% return, and some of it's infinite. And I was asking my multifamily friends, why are you guys doing this? You guys getting 8 to 10% return. I mean, this was like 5 years ago, and why are you guys doing 10% return, right? So. And nobody can really explain to me well. I mean, maybe because I do not know. Maybe they are too much into multifamily, or they never done single family. Right? That's what we have done. So I thought I was really a rock star in single family. So I was like, it took me almost 1 week trying to figure this out. Why people are doing multifamily? Why people think multifamily is a much better investment, right? I mean, on top of the scale and having a staff and reducing our hands-on effort, right? So and after probably 3-4 days, I realized, oh my God, the power of multifamily is the force appreciation, where you're able to force appreciate a value, and if you're able to refinance that out, and now you get a very, very small cash in the deal, which basically will increase your cash and cash much higher, or most of the time it can be infinite return as well. So the force appreciation power of multifamily should not be underestimated.
Absolutely. You have another example for us?
Yeah. My second deal, which we also went almost on a full cycle. I mean, sometimes full cycle can be defined, you sell the property, but a lot of people define refinance as a full cycle as well. And we are usually the buyers. We don't usually sell our deals. We are long-term holders, so we like to buy our deal at a really good price, force appreciate the deal, and then refinance and keep that property for longer term. Right. So the second deal we almost did the same thing. It is 174 units in San Antonio, Texas, where we bought it at 6.9 million at almost 39 a door. 39 or 37. So I think it's 39 a door. And what we did was we put in $1.5 million of rehab within 12 months, and we pushed that $6.9 million valuation which we bought to almost $13 million in 12 months.
Oh, so you nearly doubled the value of the property.
Absolutely. And we refinanced almost another 170%. I don't know why 170% is always keep on coming, but it was 117%. We moved it into a long-term, Fannie Mae loan, but we refinanced almost 117%. We took out 17% as part of the future rehab, and we keep it aside, but we did distribute 100% back to our investors. So now we have another infinitely returning property within 12 months. So that was a huge amount of work, but as I said, we work really hard. My wife and I work really hard. I'm a very strong project manager in post closing to manage all these rehab properties. He's a very strong construction person plus property management as well. So we're able to turn around properties very quickly.
Now, how did you find that property?
That was also an off-market deal, which we found using our text blasting to the sellers, and we found the seller, and the seller were having some kind of partnership issues, and they decided to sell this property. And this is not mom and pop sellers; they are advanced brokers, but they are brokers in land development. So they buy land and they split the land and they sell it to. So they did try to come into multifamily space, but they realized, operation of multifamily is a lot of work, and if you're just relying on third party, it's going to be hard. So they decided to get out of multifamily at that point of time, and they sold to me at a market cap rate, but that market cap rate have tons of upside once we go and put in our own capex into it.
Yeah, so that was a market cap rate at the existing NOI.
Yeah. They didn't sell me at cheap price. I mean, we didn't get this deal at below market. We got it at market, but we know we're able to work hard and push up the rents and reduce the expenses and increase the property valuation.
Well, you also did something that I like to think of as you brought fresh money into the deal. And fresh money is, they may not have had what was it, $1 million and a half you put into the property?
Yeah, $1.5 million.
Yeah, so they may not have had access to the million and a half that you needed to fix that property up. Well, by selling it to you, you can structure your raise from your investors and the type of loan you get to bring that money in.
Yeah, absolutely. Yeah. So sometimes distressed properties or distressed owners or owners who had these properties for long term, I mean, a lot of them are happy with just the cash flow that's coming in, but sometimes, they could be something that, triggered some event. Some event that triggered that they want to sell, right? So these are long-term property owners, but they had some kind of partnership issues and they wanted to sell.
Yeah. Now, the money you put into it, was it the typical thing, rehab the units, improve the property, raise rents, or was there other strategies involved?
No, I mean, this is basically where we spend almost 700,000 or 600,000 into interior, where we go and put in new flooring, paint, fix all the baseboard, new appliances. We put in stainless steel appliances because we can afford to put in to just push up the rent. We also did crown molding as well for the apartments. That may not be needed, but we did put it in just to quickly push up the rent. And also for exteriors, we did the paint, we did the pool resurfacing, and we did the office remodeling, and just give that whole community a modern outlook.
Yeah, nice. And you mentioned your yellow letters. It sounds like you've had a lot of great success finding off-market deals by doing direct mail.
Yeah, absolutely. I mean, for a newbie to get started in commercial is really hard, especially for the past 5 years, right? So, 2010, where you can find a lot of deals out there because that was the bottom of the market, and a lot of people got started that time. There was a lot of deals on the market which nobody wanna buy at that point of time, and at the same time, there was also coming back to 2015. It was really a hot market where we need to go and find our own deals, and a lot of brokers doesn't want to talk to any newbies. Right, so I decided to, let me go and market direct to sellers. That's what I did for my single family, right? So, and after a lot of hard work, we did find sellers of multifamily who are willing to sell off market to us.
Well, I love that, because a lot of the conventional advice is form relationships with brokers, because they're the ones who are going to show you the opportunities that are out there. But you were not having any success with that, so you just circumvented the brokers altogether.
Yeah, I mean, whoever giving that advice, they probably have started in 2010, 2011, and 2012 when it was a buyer's market, right? So you can form relationship, and the brokers will definitely come and give it to you. But if you're a newbie who have just starting out in the past 3-4 years, it's going to be very hard because it has become a seller's market, and there's just so much of sellers. There's a lot of buyers looking for this deals, and prices have gone up so high, and brokers doesn't want to risk their commission by just giving it to any newbies, right? So to get started, I would not recommend going to brokers to find deals. They either give you deals that all the experienced guys have given up, or deals with some something wrong with the deal. So I mean, you probably can still work with the brokers, but your chances of getting a good deal, it's going to be low.
So I want to talk about a book that you're writing. And by the time this episode comes out, it will probably be available. And it's a book for passive investors. You mind telling us about it?
Yeah, absolutely. I mean, so when I come to commercial real estate, which is basically multifamily area, and when I started raising money, I really worked hard to find really good deals that make sense, and I make sure the deal works. I have a good plan. I was being conservative. I have the buffer, and I go and present to my investor base, and it got oversubscribed, right? So when I did my second deal, when I raised money, we also found a great deal. We had a great plan, and we were happy that investors were happy subscribing to our deal, and we got oversubscribed by almost 100%. And I start asking my investors, some of my investors that I know who have been investing with me in the earlier deals, and hey, how do you guys choose this deal versus other deals? And to my surprise, a lot of people that have been investing in my deal, they didn't invest because they know me or they know the deal or they know the market or they know the numbers behind it. They just invest in all the deals that were presented to them, and I start realizing that passive investors are really not educated on how to invest in the right investment, right? And I also realized that there's so much information for active investors, right? Like how to find a deal, how to turn around properties, and all that. But there's no real book for passive investors, right? So I said, okay, because I want my passive investors to really, really learn what they're investing on, because I want them to be educated in syndication, multifamily syndication, and how the whole real estate game works and how does the syndication works. So I decided to start putting up and writing a book on it. So the book is called Passive Investing in Commercial Real Estate: Insider Secrets to Financial Independence. And it has really like 7 chapters in it with great topics that's being covered. That's going to be very, very educational for passive investors. And I wrote this book to look at a passive investor perspective on any deals that's presented to them. And this is not only covering multifamily. This is also covering to a large part, commercial real estate, which is basically retail, industrial, and office as well. Because as a passive investor, you really don't care whether you're investing in multifamily or you're investing in office or investing in warehouse, right? You want to make sure you're able to analyze the deal or analyze the opportunity in front of you from your standpoint. So it's covering a full spectrum of commercial real estate.
So James, what are some of the things that passive investors should look for when they're looking at opportunities?
So some of the topics that I'm going to be covering in this book is basically at high level, a passive investing, which is basically what are the benefits of investing passively, right? And I'm going to cover like who can invest into these deals. This going through at high level the SEC regulation and what are the cons of being a passive. What's your blind spot as a passive investor? So that's why I call it, a lot of it is insider secrets, because I'm an active investor as a syndicator, but I'm also passive in some of my friends' deal. So what are the cons is I want to make sure that people know what are the cons of being passive, and how do they choose market, and how do they diversify, right? So do they diversify across syndicators? Do they diversify across markets? Do they diversify across asset class? So what else I've been covering? What are the different types of deals? What are the return metrics that we're looking at? What are the pro and cons of different deals? And what are the different types of offering out there? Like a blind pool versus specific pool versus funds. What are the good? What are the different aspects of that? What are the different types of financing that a syndicator would take on? I've realized some of the passive investor doesn't even know what kind of financing the syndicators are taking on. Like there's a bridge loan, there's a HUD loan, there's an agency loan like Fannie and Freddie. They need to know because they are investing into the deal, even though they are not actively operating the properties, but their money is on the line, right? So they have to know, what kind of financing is being taken. And then how do they get started as a passive investor? What are the pro and cons of different types of venues for them to get started? Where do they meet deal sponsors, right, or syndicators, right? So how do you engage with the deal sponsors?
What about just things to look for in a sponsor, a deal sponsor? What are some positive signs that you might want to invest with a particular sponsor? And what are some red flags?
So I dedicated a whole chapter on deal sponsors, one of the bigger chapters that we have. I mean, because at the end of the day, we all, as a passive, you are investing not on the spreadsheet, on the market, or on the deal. You're actually investing on the sponsors, right? So, and even when we talk about sponsors, there are many different sponsors. If when you look at investment, right, they are. It's crowded on the top. In some investments, it's crowded on the top. On the GP side, it's like so many people on the GP. There are like 5-6 people in one GP offering, and it's surprising to see who plays what role, right? And a lot of times, passive investor doesn't really ask question, hey, who's this person, what is their role, and who's this person, what's their role. But I think coming back to the GP, there's a lot of emphasis that I'm going to put on the operator, right? So there'll be one guy or one or two guy who's going to be the key operator of the whole investment. So first of all, you have to know who is that and what's their track record. How to choose the right investment with the right operator. What are the different types of compensation that the sponsors take? How do you check the credibility? How do you communicate with them, and how do they choose investors, and how you can be getting a preferred a preferred option to get into the deal, and what you want to watch out, right? So I've just dedicated one whole chapter on how to work with the sponsors and how to see how credible they are, and to find that one guy who's the operator, because the operator is the key guy who's going to decide on the success or failure of that deal.
As we wrap it up here, I'd like to just get your advice for our listeners out there who are looking to invest in multifamily, or whether it be as a sponsor or to invest passively. What would you say to them?
Well, as a sponsor, make sure that you underwrite your deals conservatively. I mean, that's still pretty high level, right, for me, right? But as a sponsor, you want to make sure that you don't do deals just because to do a deal, right? So as I said, market is so hot right now. Everybody want to be a sponsor. I mean, that's not everybody, but a lot of people want to be a sponsor, and just because they can't get a deal, they just get any deals that marginally make sense, right? So. And I've seen a lot of sponsors who are buying in a high crime rate area, or an area where it's not developing or not gentrifying, just because they have to do a deal, right? So because there's so much capital right now who want to place their money into real estate. So a lot of sponsors know there's so much capital out there, so they are like forced to find deals that marginally work, right? So it's a balancing act between making sure that you have buffer in your underwriting, at the same time you are able to scale gracefully without compromising your underwriting, right? As a passive investors, find that operator in any investment they make, and make sure that the credibility of the operator. As I said, not everybody is an operator in a GP position, right? The people you're investing money, he may not be the operator. He might be just the money raisers. So that's part of the thing that I covered in the book. Who are the different people in the GP ship, I would say, right? So you have to find that one single pilot and make sure that you find that pilot's credibility, and make sure that you can buy into his credibility and invest based on that operator's experience and track record.
Great advice. And James, how would our listeners get a hold of you?
They can go to my website. My website is called Achieve Investment Group. Achieve is like achieving a goal. achieveinvestmentgroup.com. My email is james@Achieve Investment Group. You should be able to find me there. I mean, I'm very good with my email.
And I'll make sure that's in the show notes. And once again, the name of your book, and where can they find it?
The name of my book is called Passive Investing in Commercial Real Estate, The Insider Secrets to Financial Independence. You can find it on Amazon.com.
It's coming out soon. By the time people are listening to this episode, it will most likely already be out or on its way.
Yep. Hopefully it comes out by the time this podcast is aired.
Well, it's been a really great conversation, James. I've enjoyed talking about how you've transitioned from the single family fix and flips to scaling your multifamily so quickly while doing a full-time job, plus building a business in property management and construction. The examples you shared and the numbers are very much appreciated. And I wish you the best of success with your book as well.
Thanks, Brian, and happy to be here and share my knowledge and my advice, and happy to learn as well as much as possible.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Mike Murphy at JB Harrison Insurance, helping real estate investors to understand and choose their best options for all their insurance needs. Call 616-868-0050 or email mikem@jbhins.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.